Welcome everybody to the Family Biz Show. I am Michael Palumbos with Family Wealth and Legacy in Rochester, New York, upstate. I hope everybody's having a great, week. We are really excited to be talking about this episode. We're joined by Van Carlson, and we're going to be talking 831B plans, captive insurance plans, and the love and scrutiny that goes with them. So we're going to get some pros and cons, and really excited about this conversation because it is a topic that I have been asked about many, many times, especially with our construction owning companies. So Van, welcome.
Yes, thank you for having me on. I'm looking forward to, we're educating out there on this code all the time. So I'm excited to be on your platform.
Great. So tell me about, your journey. I can't imagine that, your whole life you went to college to figure out how to do 831B plans and captive insurance.
But,
we always find it interesting. What were some of the in the 3-minute version of the twist and turn of Van Carlson's career to get to where you are today?
I'll try to make it 3 minutes real quick. So, I went and did my 4 years of service, and I got my GI Bill. I came back and went to college. At that time,
thank you for your service.
It was a great 4 years, and I wouldn't be where I'm at today if I didn't do that. So, when people tell me thank you, I'm like, thank you, because it was a great 4 years, and learned a lot, and I grew up fast, right? Anyway, at that point I was working for FedEx. I saw myself going through middle management, selling my soul to the corporate store, and I was willing to do it. And then I got introduced into potentially owning my own business through a property casualty agency. And I said, man, if I'm going to work 60, 70 hours for a company and do the blood, sweat, and tears and learn to hate Christmas, because all managers do that work for any of those shipping companies,
Sure.
Do I really want to, and then I had to move and all this other stuff. And we live in Idaho, and, if you live in Idaho, you have a certain mentality of wanting to be out in the outdoors all the time. And so, I just said, I'll believe in myself and take a shot. And that's really where the property and casualty, I started off pretty successful. Idaho's been growing for the last 20 some odd years now. So I've been in risk management, and, like every small business, as you grow, you wear all the hats, and as you build out your team, you're giving those hats off. And I ended up just dealing with commercial clients, small business owners, mom and pops, great people, risk takers beyond belief, good community supporters, know their employees inside and out, all that stuff, right? And because I was one of them as well.
Sure.
And then 2008 came along. I was introduced to this idea about self-insuring risk and how do you mitigate that risk more effectively by utilizing a very low tax code. But I wasn't that interested. And then when 2008 happened, unfortunately, I saw a lot of those good people. Maybe they weren't astute about all the business structures they were involved in, but nevertheless, they found themselves going out of business, and affected my business too. Though, they stopped paying their premiums as well. So, I had to look at some different ways of doing business. And, I looked at this, what do smart people do? Well, smart people take advantage of all the rules out there in order to play the game the best they can. And that's when I became a strong believer in this program. So recognizing the financial risk business owners take, because unfortunately, that financial risk is limited in scope. I mean, like, we're coming into the fourth year, right? Or fourth quarter, excuse me. Unfortunately, a lot of people think they got to go buy more stuff to accelerate, depreciate the equipment. And I used to love that when I was in property casualty insurance, because the fourth quarter came along. I got phone calls too, right? The
CPA was like, little bump there.
Yeah. Hey, I'm going to buy a couple more trucks and a couple more skid steers. What's it going to cost to insure? I'm like, great. I'm in, The problem is they financed it. They didn't pay it off. They didn't take the tax savings and put that down on the equipment, right? They just financed it. And when the craziness to that, here's the craziest part of that. If you're having a good year, you're just betting next year is going to be better, because you just took on a lot more debt. I mean, it's the biggest trappings that I think small business and family-run businesses have. And so that's that was not appealing to me. And so that's where this program really takes over. And I think the reason why the code exists, I mean, it's an 831B tax code. We can dive into that a little bit, Michael, if you want. I'm happy to do that. It's tax code. It's really exciting, but
now why don't we give the layman's version of what IRS tax code 831B is?
Yeah. So I kind of started the conversation. There's two tax codes that allow business owners to defer taxes in their business, in their S corps, LLCs, or even in their C corps, and that's the 401k and an 831B. Now, the 401k is designed for their personal retirement and their employees' retirement. And 831B allows you to recognize self-insuring risk and defer dollars into that self-insuring risk. It was passed in 1986, and a lot of people don't know about this tax code, but it's been utilized literally for decades now by Fortune 500 companies and significantly large companies than yours client and my client. So when it was first introduced, though, it was the farmers that were self-insuring crop insurance. And because what was happening is private sector was getting out of it, right? Because it became very volatile. It's like the hurricane sector, right? The insurance companies, for-profit companies don't want to insure those type of volatilities. So they got out of it. And meanwhile, farmers were stuck, like, how am I going to I'm self-insuring my own crop insurance. Now, today, Grant, when you hear farm subsidies, it's almost all crop insurance related subsidies that go on out there in the country today. But that wasn't happened back in 1986. And so Congress got together, Tip O'Neill, Ronald Reagan. I mean, that was the year, those were the I guess the decade when there was actually compromise, where people actually sat down and was civil with each other. And that was my only little tidbit for the politics for the day. I'm out. But civility has, it'd be nice to be civil, right? But anyway, so, they came about, and both, the Congress is ran by Democrats, and of course, the Republicans had the White House. But, those were great compromises. I would tell you the Tax Reform Act of 1986 was by far the biggest tax reform act we've had, certainly in my lifetime. I mean, this last go around is minuscule compared to what happened in 86. But nevertheless, that tax code.
Let me jump in for just a second, Ben, because you just said something I think is really important that I only know because my father was a financial advisor, started in the mid 70s. And so he went through all of that stuff. And so that Tax Reform Act of 86 did some things to close a whole lot of loopholes in the real estate market. It made some investments almost worthless at that point. But what you're telling me is at that same time, that's when the 831B was introduced. So here they're getting rid of, and this is an interesting point, they're getting rid of tax loopholes, but they're creating tax code that's real and helpful for some of the business owners out there.
Yeah, absolutely. I mean, when you look at self-insuring risk, right? If I have a risk that's specifically to my industry, my business, and I can't transfer that risk through traditional means. I can't buy a work comp, general liability, or property coverage for this type of risk. So I can't transfer it. Well, I'm self-insuring that risk. Okay. Well, if I just took a good example would be warranty, right? Or we call it non-merchantability warranty. In order to do business today with a lot of retailers, you got to honor their return policies. Well, it's not a defective product. It's a fairly good product. It's just there's such liberal return policies today that it's not Target or Costco eating that. It's the distributor and the manufacturer that's eating that. A lot of consumers don't know that. But, so there's a lot of risk that goes into these businesses, even when you do those. And that's all self-insuring risk. Supply chain risk. Look at supply chain today, right? Hugely strained. You're self-insuring that risk. You're self-insuring your brand protection today. If due to social media, it takes seconds. It takes years to build up to be a reputable company. It takes seconds to be destroyed, whether it's true or not. Right. And you got to be able to defend that, right? So where's that money going to come from, right? So these are self-insuring risks that business owners have today, and that's just a few that we can, I'm highlighting them. But the reality is you can't just sit there and take $1, park it off to the side, and say, hey, if something happens, I'm going to use this $1. Government says no, that's self-insuring risk is not a deduction. So that's why the code even became in existence. At that point, it's $1.2 million a year. The PATH Act made some changes, so the state tax guys that were out promoting it, and that's really what happened. We call them the Google experts. If our clients were to Google 831B today, they would see a lot of a lot of heat on it, truthfully, and I would just say that. But the problem with that is the heat came from attorneys out there promoting this program, not as a risk mitigation tool, but more of an estate tax tool.
Mm.
And that's really what brought the cases up, because, you know, you look at '09, these cases that were tried, and the IRS is, I think, one of the last 4 cases under the 831B tax code, were not done for the purpose of risk mitigation. It was solely for the purpose of estate taxes, because you also got to go back at that time and look at what the estate taxes were at that point, right? I think it was $1 million or $2 million. I can't even remember the, anyway.
Sure.
You know, that I was a little guy and young at that time, so I can't really. but you know what I mean. So there's other motivations going on, and anytime, you know, I think with the IRS, my experience and just being an observer of things is, you know, get me once, don't get me twice. And unfortunately, you know, and then some of them even got them third time because they went and put life insurance inside of them, and then they were out there promoting tax-free income. And, you know, anytime that.
Pause you for a second, because I think I just want to make sure that nobody missed what we were just talking about there. So tax code 831B exists in the IRS code, but just like anything else, if you take it to the nth degree times 10 and hope that you're going to get, you know, all kinds of benefits from it. And I you know, being a wealth advisor, we don't sell life insurance, but we do help a lot of clients buy it because there's a need sometimes. It fits a purpose.
Couldn't agree more. Could not agree more.
So, but then if you're trying to sit there and say, my life insurance policy is going to handle, you know, my survivorship planning, my estate planning, my college planning, and I'm going to get my retirement planning out of this one in life insurance policy, I got a funny feeling that you might be missing what the point of owning life insurance is.
Well, Michael, to add to that, they're using it to fund it with tax deferred dollars out of their 831B plan.
Right.
Which is, I mean, I get why the IRS is upset.
Yeah. So
you know what I mean?
What we're saying, because I skipped that, is what we're saying is you can take something really good and anybody can make it bad if that's what they want to do. And so there were some bad apples that, you know, went after these 831B plans and said, we're going to show you how to make tax-free dollars, use it for your estate plan, use it for everything possible. And at the same time, though, it's making it tough for people that really have some of these risks. And the risk that you mentioned, like brand risk, every one of my clients, you know, if you're in the middle market, you're doing between $10 million and $200 million, you do not have a fund typically that you're setting aside for brand, you know, management risk. And that's a real risk, God forbid, especially if I've been in business for 25, 50 years, right?
Absolutely. Yeah.
Okay. I'm with you so far. Yeah. And I think that makes
unfortunately, think about last year. How many people had political risk? How many people had indirect business interruptions? So the problem right now is all these lawsuits are being come up where the insured is suing the insurer for business interruption, but there's a specific definitions in the policies about indirect and direct losses. Direct losses are my building caught on fire, I can't work in there anymore. That triggers business interruption under the underlying coverages of the policy. But the fact is the dental office was perfectly fine. It was just forced to shut down by the municipalities or state government.
Yeah, nobody have insurance for that. And that's exactly the kind of thing that you're talking about, a supply chain,
absolutely,
pandemic insurance, you know, the things that, you know.
And quite honestly, the other one is going to be dispute resolution. I think from what we're seeing already with our clients, I think the lawsuits that are going to be coming in the future over these situations is going to jam up court case. I mean, the court case is already jammed up, right? But it's going to get a lot worse, unfortunately. I mean, there is so much things that got to get worked out because this is unprecedented in our certainly in our lifetime, and maybe even to the extent of the impact it has on the economy and people individually. And so it's going to be really interesting. But nevertheless, I mean, you know, I love risk. I mean, I hate to say that. People are like, what? But you know, I could pretty much talk anybody out of anything. I could tell you everything that could go wrong. Trust me. I mean, you start to develop that, and I don't know if it's a sickness or not, but it's something, one of those things where, I always want to be the guy with, the glasses half full, of course, but, there's a lot of risk, and unfortunately the world's getting more complicated all the time.
Agreed.
And here's the thing about traditional insurance carriers. They do a really good job. They've done very well financially. They're not in a big hurry to take on more risk anytime soon, especially after this ordeal. So I think for the long, this tax code is going to be around for a long time. It's going to become, we tell our clients and we tell anybody I speak, these platforms are in front of audiences, that this will become a normal business practice, no different than the 401k. I mean, going back, to the 401k model. So, and I'll kind of explain what we do as a company too, real quick. But so really, when you look at the 401k, it was very, very expensive to do in the beginning, right? I mean, it was only for big employers and all that kind of stuff. Now we've got it down. The fees have been beat down. We've got good case precedents. We know what the ERISA rules are going to be, and it's a regulated form of business. And it's assumed that every business owner, you wouldn't offer a 401k to your employees if you couldn't if you couldn't take the deduction, you wouldn't do it, right? So that's a tax incentive, to provide a retirement plan. And then now you get the 831B. What we are as a company, because we certainly aren't here to complicate business owners' lives. We're an admin under the 831B tax code. No different than if I engaged a 401k admin. You have to have an administrator. You got to know the rules. You got to know the rules of engagement. How do you comply with the tax codes? What's fair and reasonable? All of those things, you have to have an administrator to administrate, and that's really where we fit in as a rule with our clients.
Yeah, and for clients, real quick, where they would understand this, on the 401k, they have their financial advisor helping them pick investments and hopefully helping them with their fiduciary responsibilities. You have the third party administrator who takes care of all the dotting the I's and crossing the T's, making sure the IRS Form 5500 is done and that you've hit all your regulation. And then the record keeper just keeps all the pieces together. So you're acting as the third party administrator to administer that plan. Is that how I get that?
No, that's exactly right. There's a 4-part test like under the 831B. Real quick, it's the transfer of risk, it's the risk distribution, it's ensuring fortuitous type risk, and then acting in principles of insurance. Because one of the things that this thing needs to look and feel like, if you took an 831B and you said, okay, I got to have a box, what's that box need to look like? Well, it needs to look like an insurance company, because that's really what it's going to be. That's what it's going to be operating as, right? So we create the box. We make sure our clients adhere to the 4-part plan. We give them regulations. We tell them there's going to be minimum max contributions and potentially forced distributions. Now, the nice thing is that box is an insurance company that's also a C Corp. So, the nice thing about a client situation, unlike a 401k, 401k is deferring taxable income in the future. The 831B plan allows you to take long-term capital gains or dividends out, depending when you shut it down or you want to take a distribution. So there's some advantages there under the tax code for now. We don't know in the future whether that's going to be a win or a loser for the clients. I hope they do, but it's about deferring taxes that you can fight the fight better. You're not having to rely on the PPP. You're not, because barring a catastrophic event, you can't expect the government to step in like they did last year, and maybe never again. Who knows? But the point is when you're deferring, if you're going to have to go fight a fight, you're going to have to go deal with supply chain risk, dispute resolutions. I could talk to you about employer liabilities. I can talk to you about the brand damage we kind of hit on so far, but even cyber today, they're so limited in scope of the traditional policies that people are buying today. Trust me, the sublimits on those policies can be devastating to your business if and you're only going to be able to buy so much insurance.
Right.
So again, these are just risk. Risk is never an issue when it comes to small business and middle market business owners. But, truth be told that, we help with that as well. I mean, that's what we do, right? We're risk mitigators. We'll hire the attorneys, we'll hire the CPAs, we'll do all those things. But as far as my office goes and my team, we're risk mitigation. Our background is being in risk management, not the tax code. Like you said, we know the tax, so we have to, right? No different than a 401k administrator needs to, but we don't give tax advice. We give risk management. How do you manage your risk more effectively in your business? And, I know a lot of your clients are construction folks, and I see right now construction being a huge risk out there. I think supply chain risk is huge right now, unfortunately. I can't do anything about pricing. Think of a future, right? You can't buy a put or a call on a future because you can't lock in a price on a piece of a 2x4. But you can certainly manage the supply chain risk of that. If all of a sudden I can't get my wood and I got to get a project done and I got to now divert to another supplier, and now I'm paying 20% more because of that. Well, that has nothing to do with supply and demand of wood necessarily. It just has simply the fact that the supply is drying up. Now, where's that additional money going to come in if I just walked into a contract? Now my profits are going to get ate down. Now, how much more risk? Now I'm taking a lot more risk on that. So supply chain's one. I think construction defects is huge today. These products that are being made today that are showing up, and then too, a lot of legislation is being passed in states where a lot of these general contractors got to hold a 10 years construction defect. And that's problematic. That's self-insuring risk, potentially. The other one I would say that we see in construction specifically is subcontractor default, where I was a general. I hired that subcontractor to come to any kind of subcontracting work you do. You hired somebody else out for. Ultimately, you're responsible for their work.
Right. The buck
and you're on
stops
the hook,
here, right?
Yeah, exactly. They're out of business, or they're out of town, or they don't return your calls. And now there's a warranty going on, or 5 years later they installed the flashing wrong on the roof. You're on the hook for that, And so those are risks that And here's the biggest thing, Mike. I always talk about when I talk to business owners. If you're having a good year, just to take a little bit off the top and park it off to the side is just good risk mitigation, but it's also really good business.
Yeah.
And that's really what I want to tell all these risk owners, these business owners, these risk takers, your clients, my clients, that hey, we want you going. You're the lifeblood of our country. Absolutely. But to recognize the risk you take and to be able to park a little bit off to the side, I can tell you this: clients that have been with us for a long period of time, and I've been doing this since 2008. Great time to start a business, by the way, but we survived and we, it was good. Actually, it's good. It's probably a good time to start a business. And when times are tough, right? You can make a lot of money during good times are good, I guess. But anyway, going back to all that, we were sitting there and working with all these different business owners, and over the years, and the best compliment we get from them is like, hey, Van, we just sleep easier at night knowing we've been in your program for a number of years. Last year when COVID first started, claims started coming through, and we had a 1,300% increase in claims last year due to COVID.
Sure.
We paid out faster than the government did on the PPP. Again, as the administrator, we're making sure the money's flowing correctly, that you're putting, if there's a claim going on, there's a process for that. All these things that we do in the background. But I'm very candid with it. I'm very passionate about that. You guys take a lot of risk, and if you can mitigate that a little bit, I just think it's good business. And not only do you owe it to your family, your legacy, but you owe it to the employees that work for you.
Right.
If I know all the rules, and I play the game well, you'll win better. All things being equal between competitors, if you knew the rules better, you're going to win. Right? If the talent was equal, right? So I always talk about that with business owners all the time. It's like, and by the way, this is just a tool, right? For the right client, it's a great tool. That's it, No,
that's great stuff. I just want to keep, because I watch our time to make sure that we get everything in. So I just want to, we talked about what an 831B is. That makes really good sense. We talked about the fact that there are some, what I would call the bad apples out there that are leveraging, every single line in that code. And a lot of times, based on what you're saying, they're doing it improperly. They're doing it for the tax reasons, not for the benefits of the captive itself. Yeah. And at the end of the day, if you were to leverage a 401k for all the wrong reasons, guess what? the IRS is not going to be happy about that. And it's just that because there's a lot more 401k programs out there, I'm guessing that that's why it's so easily codified and people know what they're supposed to be doing. That does not take the complication out of 401ks. We happen to be 401k specialists in my office. And I'm always, every time I'm introduced to somebody, how often they're out of compliance because they don't know the code because they're in another industry. They're in construction. They're not in the 401k business. It just happens to be a benefit they have to give. And so I think, this is sounding to me for the first time. I want to say thank you because I'm starting to understand a little bit more around this 831B. Now, again, we talked about that, those bad apples, that caused the IRS to send out a soft warning letter to people that were running an 831 captive. Give me some of the hit points. What are they looking for? You mentioned, do you have life insurance inside the plan? What are the other things that, would help you to know the bad apples?
Yeah, I wrote an article for Forbes, actually, outlining the 5 bad principles of captives. And that's really has to do with, improper risk, no pooling of risk, really not following the 4-part test, ensuring implausible coverages. Those are the things they're looking for. There's some downstream issues I think that we do a pretty good job with as well. And I would just say that, and I make it very, I tell clients all the time, because believe me, we get a lot of clients coming from us from other administrators. And one of the rules we have is okay, you've been doing this for 8 years. How many claims, unfortunately, when you talk about distribution of risk, you can't own 100% of your own risk and call yourself an insurance company under the rules. You have to have some risk that's unaffiliated to you, because one of the things the insurance companies do is how do you leverage the law of large numbers? So we'll create co-op pools that you're going to have to share a little bit of risk of other people's, under the brand damage. So you have the potential to pay other people's claims, but we manage that through the law of large numbers. We have 300-400 clients in a pool. We're able to manage that much more effectively than if there was one person in the pool, right? So that's another big one. That's really where they got caught. A lot of them they just weren't distributing risk. So one of the questions we ask our clients, our clients that have already been doing this program for a while, is, have you had other claims that were not your own? And if they tell us no, well, then that's probably a problem. That's a little bit of a potential red herring that,
okay.
Were you properly pooled to begin with? Because last year, I would tell you, all of our clients had claims, whether they had their own claim or not, because there were so many claims last year. But we managed that. That is a calculated risk business owners take to do an 831B. You have to have distribution of risk. And if you don't have it, the courts have found that you're not an insurance company. Well, if you're not operating as an informative insurance company, then you can elect under the 831B. And that's really how they were able to capture everybody. And truthfully, that was the warning letter that was sent out. We've been doing this for 12 years. We've had no issues with the IRS. The tax code's going to be here for a very long time. It's not going anywhere anytime soon, especially after last year. And unfortunately, it continues throughout this year. And so that all being said, there's, to your point, Mike, there's right ways and wrong ways of doing things. And it's always been something in our history as our country that we'll have people, they'll take the line and they're going to constantly try to be moving it, and for alternative motives. And, this thing, as good as it gets, is deferring the income in the business to be able to fight the fight in a more efficient way. Because here's the thing, you're going to get 2 to 4 times more in that dollar than if you just were trying to use after-tax dollars. And I can't tell you how many business owners I've sat with and said, okay, what are you doing with this? What are you doing about this risk? Well, we take that risk, and, but you recognize that as income. So if you make $1 of profit and you're going to take that dollar and set it aside, then you're down to about 50 to 60 cents, depending on your tax bracket and your pass-throughs and your state, all that. Wouldn't you be better off to take $1 to $2 versus 50 cents or less to go fight a fight? So those are things that's really where the efficiencies of the business happens. And I think, just like you, it's education, knowledge is power. And again, for business owners that, lose sleep at night, truthfully, over these types of issues, this program can help relieve that. And that's, and to be, when I was back and running my property casualty agency, I had clients that became friends, and they said all the time to me, Van, you're a great guy, you're a good guy, but every time I see you, you cost me money. And that's, it's just property casualty insurance, right? But,
Sure.
With this program, we're making our clients sleep easier at night, and you elevate your professionalism with your business owners. And again, just getting the word out on platforms such as yours, and and letting people know that this is out there available to them. We're very conscious of fees. We don't want fees to ever kill a deal. We believe every small to middle market business owner will own some kind of form of an 831B plan. And it will become a normal business practice. I think self-insuring risk is going nowhere but up from here, unfortunately.
Yeah, no, that makes an awful lot of sense. So let's go through again, and we captured some of the different types of risk that people would, that would do, but maybe we can break them out into some of the different industries. So if, you talked about the ones in construction, where it was project risk, and some of the other ones, but maybe inside of manufacturing, maybe inside of professional services, maybe if you just kind of go through so that the audience can kind of get an idea to say, oh, that makes sense.
Yeah. So what, a lot of times we go to the client, tell us what, and it's been, unfortunately last year we had a lot of new ideas come to us because we didn't, because of COVID, right? Because we're like, oh man, we should have had coverage for that. So we do a lot of depending on the industries, right? We deal with a lot of medical community, dental communities. We're looking at deductible reimbursements, where today, unfortunately, to offset some of your costs in traditional insurances, you're taking on more risk. We have a specific program where you can do a 831B, and it's called IRE. It's an IRE program, but you can take over your traditional insurance as well, and you pick and choose the deductible level you want. And that deductible difference on savings of the premium, we're able to tuck into an 831B. And now we're able to build those reserves up. So if you're going to take on more risk for higher deductibles, you don't have to worry about current cash flow to make good on those unexpected claims that come up, but it's the profits from the previous years. And so that's a really efficient program, which, we just did a webinar on that, and that's a good thing. It's very happy to have that come to the market. It's a Lloyd's of London product, and I think it's going to change a lot of clients. You're still looking at about $150,000 to $250,000 in traditional premiums on all lines, but for the right business owner, again, it's a great solution for them. So, but the overall, I would say, is the intangible assets of a business. Like I was saying earlier, traditional insurance companies do a very good job insuring the tangible assets, the buildings, the autos, things that people have to get a loan on, or they can touch and feel, right? They do. I believe traditional insurances do a very good job with that. But when you look at the intangible assets of the business, is where most business owners really put the value on the business. The blue sky, right? And that's really where they fall down. And again, it's very hard to quantify. How do you determine losses? I mean, all sorts of stuff. So it gets back to brand damage, intellectual properties, contracts, all of these things. Your reputation in the community, and then it goes into the supply chain, the contracts you have with suppliers, your all the things that bring the value to your business, and the intangible. When I make a presentation to business owners, and I ask the question, what do you value most, the intangible or the tangible assets of your business? And 9 times out of 10, business owners are going to tell us it's the intangible. Well, what are you insuring for, the tangible or the intangible? And so, when I don't want to get specifically into certain risks for any industry, but just know that, unfortunately, a lot of industries across the spectrum, and believe me, the nice thing about this business is finding out how people make money in this country. And man, I tell you, we got some unique businesses out there that do very well, and you're like, who would have known, right? And
Right.
It's one of the great things about our business, but I'm sure you see that too. And so that might be specifically to that business, right? And then we talk about the big one we see right now is recalls happening more and more too. And so I can go on and on about that, but I just want to make sure that clients understand, the listeners understand, it's the intangible assets of the business we want to identify, and are we covering that or not through traditional means? And if we're not, then what are we going to do differently about it? And
Okay.
that's really where we can dive into that risk profiles of those specific businesses or industries and go that route.
So when you're looking at your typical client, let's go through and say, who is the right fit client for this? It's not about industry, but I have to believe that if I'm, there's probably some revenue numbers or costs or whatever that are involved. So let's paint that picture for somebody so they can say, oh yeah, that's me, or anything above that.
Yeah. So I would say, we deal with clients from all sorts of spectrums when it comes to gross revenue. Your gross revenue of your business drives the ability to put more premium or less premium into the program. It's no different than when I go to traditional insurances and they want to know what was your gross revenue for the year. The higher gross revenue your business is, the more you can expect to pay in premiums, right? That's the correlation there, right?
Sure.
So, but that being said, we have dentists that will only do $30,000 or $40,000 a year in the program, and we have other practices that will do $2 million a year. The most you can do in this program is $2.3 million a year into the insurance company, into the box, into the 831B plan on an annual basis, and still be able to elect under the 831B. Now, again, there has to be some actuarials put in place. There has to be some rules put in them. You can't just say, hey, I want to put 2.3 million in. That doesn't work that way.
Fair.
Right? There's rules and regulations that, again, we as an administrator make sure you adhere to. But so we get it from all GAMs. But I would just say on average, if you can, if you're doing more than $1 million in gross revenues, and I would say at minimum you want to do at least $80,000 a year into the program. That makes it work. The nice thing is we have some fixed expenses. If 1 year, you can't afford to do anything, it's not going to kill you to own these things. That's another thing in our program. When we designed our program, we want it to be such a compliment to our business owners that they weren't going to get eroded any advantages that they would have had over the years due to fees. And so, we're very proud of that. I think our record shows that, based on our growth, the amount of clients we have all over the country, that, we are the low cost provider with 5-star service. And that's what we try to implement every day. And I think our success shows that.
Great. So that helps me on that arena. Like we talked about, I think you said that you're creating a C corporation. Does each individual create their own C corporation, or is it just they become part of the one?
Yeah. So each client will have their own C corp.
And where are those being registered?
Well, that's the interesting thing that we do. We do them domestically, but we do them on a federally recognized Indian tribe in Oklahoma. And that gives us the ability to be a domestic company, so we're not subject to offshore issues. It still files a federal tax return. You get an EIN number from the state of Oklahoma, and you have to have a tax return on it. We, as administrator, provide all of that, and we also provide the third-party CPA firm that will administer the tax return. We don't expect our client's CPA down the road to do these tax returns for this tax code. So we try to put it all in one box for one client. So again, we're not here to complicate business owners. I think they already have enough challenges already in life. We're just going to try to be a complement to them, and that's really the educational process to that. The nice thing with the tribe that we work with, we're doing a lot of good for that tribe. When I first started this, there was 8 states promoting you to own your insurance, this 831B plan within the state. It was Utah, and Delaware was well known for it. And I think Nevada was doing it. Montana was doing a little bit. There's now 34 states promoting you to own 831B plans in their states. And of course, the big guys go offshore. They have no problem going to Bermuda or Cayman. But typically our clients are a little reserved in that. They don't, when they hear offshore, that's for the big tech company guys, I guess. But because a lot of big companies own a lot of these insurance companies all over the world. I mean, I can tell you Microsoft owns about 20 different insurance companies. So, nobody's selling them product liability insurance. They have to self-insure risk, right? But aside of all that, we're helping the tribe out immensely with programs they're starting for, scholarships for their members of their tribe, all the way down to school assistance and daycare assistance. I mean, the revenue is being generated on these tribes, on the tribe that we work with, is doing it no different than the white states want to. They want the premium taxes and they want the revenues for the domicile fees. And so I really I'm very passionate about that as well, where, it's important where your insurance company is going to be held at, where your 831B plan is going to be held at. And what better place than a federally recognized tribe that's trying to better their members and maybe don't own the big casinos and do all those other things. And so it's a big advantage to our business owners.
So walk me through it. And again, just because I think it's helpful for people to understand.
Yeah, no problem.
We talk about, and that's what, one of the things that I've heard many times is that, they're developing their C corporations or, offshore. And that, as soon as you say offshore to me, I start to say, okay, what's going on? Why are they doing that? One. And then you keep them in the U.S. domestically done through, on the Indian reservation. What's the benefit there? And what part of the code, makes that work or not work?
Well, the code really doesn't recognize domiciles at all. The domicile has never been an issue as long as there's regulations put in place, and these regulations were adopted under the Utah regulations by the tribe. But the reason why they would have gone offshore is to really get around state regulations. Unfortunately, everybody's looking for revenue, and it gets to be very expensive. You're dealing with bureaucracies that can become pretty encompassing to do business with. Okay. You have to show every regulation of what coverages you want to put into your captive. You have to have capitalizations. You have to have prepaid premium taxes. So you start to get these regulations put in place that I'm sure at one point everybody thought they had to have, or, had a goodwill. There's regulations put in place to protect the consumer and protect the state's interests and everything else, right? But you get to the point where there's so much regulation, and every regulation adds more cost. And so that's really, yeah.
We're on the same page, so that makes sense to me. So what you're saying is, I live in New York State, and I know some of the people that listen to this. I've seen the statistics. There's some people in California. We might have a little bit more, state regulations than other people. So even though there's a federal law that mandates how this is done, on top of that, you also have state laws of how things are done. And so by domiciling your C corporation, via the Indian reservation and that you utilize, and where the big companies will go offshore to avoid those state pieces. Did I catch that right?
100%. And the nice thing about keeping them onshore, you're able to still bank wherever you want to bank. We have great banking relationships out there, and you're able to manage, have your financial advisor, guys like you, manage the reserves, and that's really a big thing too. I mean, money needs to make money, right? I mean, you just don't put $1 inside of a 831B plan to stare at it, So, that's really where another big, more exciting part of the planning opportunities. When I was doing the property casualty insurance executives, I got to know those guys. I was pretty successful at it. So I went to conferences and spoke and all that stuff. And I remember talking to those executives, and they're like, yeah, you guys sell it. But, really the exciting part goes on in the back room when, they're moving $1 billion around. What are we going to do with our $1 billion this year? That's a little bit more exciting about me selling a home and auto insurance to, a family that has moved into my town. But, and so I say that cheek and tongue a little bit, but it's true, you're able to build these reserves up, and it does become a very sizable asset class for business owners. It can be a game changer. It can be the ability to grow your business, to get out of your business. That's the biggest, somebody always asks us, who's your typical client? And I kind of say it, and it's just where we're at today, love a hater or whatever. But the reality is, a lot of people put their blood, sweat, and tears in their business. Every dollar they ever made, they put back in their business. They were so successful, they sent their kids off to school thinking they were someday going to come back and take the business over, and they got other interests, and God bless them for doing that. But they don't want anything to do with the business. And now they're staring at it going, how do we get out of here? And that's the biggest challenge business owners have. I think small business, middle market business owners have today. Obviously there's a lot of money out there. I think some businesses are being probably more sold this year than I've ever seen with small businesses. But, that's because of where we're at today too, right? But my whole thing is, if we can bring different solutions to other problems and manage risk more effectively, I just think you owe it to business owners. Business owners owe it to themselves to understand this code.
That makes
And
sense.
whether you want to do it or not, I would tell you all your clients are eventually going to hear about it. All the business owners need to understand it, and this is one of those tools where you have to work on the business and not in the business, and understand it, and fully understand the risk you're taking. Know that there's a little heat coming from the IRS on it, and understand why there's rules and regulations put in place that you may not like at times. One of them being potentially paying other people's proportion of other people's claims. But if you don't have that, that's a red flag. I'm just telling you. All those things that, I think is very important to business owners today, for the survivability of their business.
That makes sense. So now I'm a business owner. Let's just say I've done the work. We put this together. I've been utilizing for 15 years. I'm 65 years old. I'm 60 years old. And, I'm about to sell my business. What happens with, the captive? Do I sell that to somebody else? How do I get out of this thing? What happens with that?
Couple things, it becomes a selling of stock. You sell the stock back to the corporation, it dissolves, and you take your reserves out as capital gains. That's one thing. The other thing we see a lot of times in businesses is, because they have warranties, they have promises made in the future. A lot of times businesses get devalued because of that at the time of sell. So we'll tell clients, hey, keep this 831B plan open. If any of these claims come up in the future, a 3-year, 4-year warranty, whatever you've done now you're able to keep those reserves in place. And hey, if there's a claim that comes through, these are the reserves we're going to pay to make these claims. Now, not only do you get you avoid the devaluation now, you can actually ask for a premium. And that's, again, guys, that's a great tool for business owners, right? It could be a game changer again for them, especially at the right time. And so for me, it's a huge tool on so many levels. But the reality is, say, hey, I call no joy. You can decide, hey, we'll allow business owners, and again, these are our rules, but we'll allow business owners up to 3 years not to fund their insurance company, their 831B. We'll still keep the maintenance fees going and everything else that's manageable, but we'll allow up to 3 years for them to close that 831B plan down once the operating company's been sold.
Okay.
And so that, and again, it's coming out of capital gains, and we hope our clients win on all that. They're winning today, through the way the tax codes are written, but we know that can change. And if that's again, I will tell this business owners all the time. I get the motivation. No different than the 401k. Congress created the tax incentive to do the program, right? But understand that if that's your motivation to defer, then this probably isn't for you. There's certainly not the client we would like. I'm sure there's other administrators that would love to have your business. And the crazy thing is, when we first started, we had a lot of business owners get motivated that way, and that was fine in a way. But with time, they really start to become a better client, is all I would say. As you get older, you get a little bit wiser, and you start to think, man, if I was able to defer some of these profits, build these reserves up in the back room, I'm just going to sleep easier at night. And that's just what clients tell us, and that's the greatest compliment we can get from any of our clients. I think that's true of any consulting profession. Sure.
So let's make that analogy and tell me if I'm right or wrong on this. If I'm utilizing a 401k for my employees and myself, I'm putting my money in. I can do it before tax or after tax, but the traditional 401k is I use my before tax money, I put it in there, it grows tax deferred and then upon retirement after age 59 and a half, I'm taking that money out and I'm paying income taxes on it, right? And during the time that I was there, if I needed to take a loan from it, I could. There was, depending on the rules of the plan and whatnot. So that's the 401k, which is, people are familiar with. With the 831, tell me if I've got this right. With the 831 plan, what's happening is I'm setting aside before tax dollars for all the risks that I may be, the intangible risks that I may be facing, and they keep mounting up on all of us on a pretty regular basis. That money goes into the 830. It goes into the 831B, and 831B is just the tax code. That's just like 401k. People don't realize that. It's just the tax code. So the 831B. So the money goes in there. And then through the years that I've been paying premiums for the different risks that we're insuring based on, a conversation and some consultation that they're working with you, and then you're putting those pieces together, they may have some claims throughout the course of the 10, 15 years that they're in there. And that's there for their benefit. When those claims are paid out to them, how are they receiving that money? So let's say I had a claim on my brand. I had a hit of $50,000 it cost me and it's uninsured. How's that money coming out to me?
So there has to be an underwriting, there has to be a claims process and adjudicating of the claim. We have a process to that. Typically, we look at the previous year's gross revenues. We compare them to the loss of income. And is there a loss of income? And then is there any outside influences of that loss of income, not just the brand, right? So there's got to be some adjudication of claims going on. Again, as we as administrator, that's our job. And then what we'll do those, we utilize a fronting company. What I mean by that is there's actually an insurance. We have a big box. Think of that as a mothership. No different than compared to a 401k would be a clearinghouse, Schwab, somebody like that, right? So the money comes through. So what would happen is let's say it's a legitimate claim. There's damages. We're able to assess and let's say it's a max claim. Let's say the policy was $500,000, just saying. The client's on the hook for the first $250,000 of that. So it's going to come out of their 831B plan. It's going to go to the mothership box. The mothership also retains some risk, so it's got to put some money into it. And then it's got to go out to everybody that, let's say it was a brand damage. So if we had 400 clients, depending on the amount of premium on a pro rata sharing, we're going to come back in and put the money in there. And then the mothership's going to write a check for $500,000 minus their deductible and everything else back to the operating company. Now, I will just tell you this. That sounds complicated, and we're not here to build a rocket ship. But I will say this. We have really good educational videos that go through the process, move the claims through the client. Again, this is part of their education. I think it's extremely important for them to get educated, know enough to be comfortable with it, move forward or not move forward. And then after that, know that they have an administrator like us that will help them always answer their questions. But they don't have to become insurance expert, I guess is the point I'm trying to make there. So, but it's a very processed way.
Gets that cash to take care of that thing. Is that taxable? That's what I was trying to figure out.
Well, it does become income to the business, right? So whatever expenses they've incurred,
just like if it was an insurance claim, just like any ordinary insurance claim.
This like a business interruption claim. It is an income. It's an income protection policy. No different than the farmer with crop insurance. Yeah.
Okay.
Yeah.
So that answers one question. Now I retire and I close down the 831B 3 years after I sell the business, whatever the case may be. If I understand what you're saying, at that point, it's whatever's in my C corporation. Is that right? My reserves that I built up. If I pull them out of there, now when I pull them out of there, instead of being ordinary income tax, they're going to be capital gain taxed.
Correct.
Okay.
As long as the premium season, I should mention, and it's just kind of where I'm at today, and because we don't even talk about taxes that much, but it's important for business owners. Again, it's like everything; it's part of the rules, right? Part of the game. I don't know if I said this, and shame on me for not saying this earlier, but the reason why the reason why you want to elect under the 831B is the premium you put into the 831B is not taxable income to that C corp. The only thing that is taxable is the investment on the income returns of those premiums. So the premium going into the 831B plan is not income, so it doesn't get taxed at corporate rates. There's the big advantage, right? One of the biggest knocks on C corps is the double taxation, right? So if I take a distribution, it's not a deduction. But the biggest thing is the premium going into these things. Under the 831B tax code and up to $2.3 million per year it's not taxable income. It is recognized income, but it's not taxable income. It's only the investment income on those reserves that get taxed.
That makes sense.
And I apologize. I mean, that's the big motivation, obviously, right? That's where the deferral of taxes come. But, it speaks to where we're at today. I mean, again, the motivation, sometimes it's for taxes, but for us, it's about risk mitigation. And I can't say it.
get that. I was just trying to look at some of the mechanics so
Yeah.
that people could understand
No,
a little bit.
that's where the rub is, right? So you're not being taxed on the premiums. If I'm putting $1 million a year and I'm deferring it out of my operating company under 162 line item deductions as ordinary and necessary expenses, and then I'm putting it into an 831B, I'm not paying $1 million of corporate taxes on the $1 million. I'm only paying what the investment income is. And then I'm coming out the other side as a dividend or capital gains. Yeah, there's some tax arbitrage going on. Absolutely. Currently there is. Down the road, there may not be, again.
Right. So you still need to be doing it for the right reasons, which is go back to 1986 when they did that tax reform. They got rid of the loopholes because people were doing real estate deals for just the tax purposes, and all those things became worthless. So if you're going into this, this session, an 831B just for the tax purposes, that's wrong thinking. And that's you're going to get burned, eventually. The right thing to be doing is exactly what you're doing. Do these things right, protect your business, allow yourself to sleep at night with some of these things. And there's risks that are uninsured, they're intangible, and it really does make sense this is something that would be worth exploring. If somebody wants to explore these things with you, if I'm not mistaken, they can go to 831b.com, right?
Yep.
831b.com is your website, and you can connect with Van there. I bet you probably do some webinars and some things that people could learn a little bit more about.
Yeah,
and
we do a lot of those. We're an educator. We're an educator out there, and again, it's been a fun road, and it continues. I mean, last year was proof of concept for a lot of our business owners, and unfortunately.
Sure.
And for some of them, it may be too late. But, if you're still in the game and you're still trying to run a business, again, I can't emphasize it enough. You need to know and understand about it enough to where you can make a qualified decision.
Great. Well, this has been really helpful for me because, like I said, we hear the buzzwords and we hear we like tax strategies, tax reduction strategies. We do not like anything that has the potential of being devastating in the wrong areas. And you brought to light all the good reasons around utilizing an 831B plan. And we're not out here, we are not endorsing 831B plans. This is just, really been educational and done a really good job with this. And I appreciate your time. Van Carlson, 831b.com is how you find him. My name is Michael Palumbos. I'm with Family Wealth and Legacy in Rochester, New York, and we are so glad that you turned in. Make sure you subscribe so you don't miss an episode as we're coming down the future with these things. Have a great day, everybody.